Good day. I hope everyone is having a great summer. We are back with our July 2023 monthly video commentary. And we're going to shake it up a little bit this month. It's going to be shorter. I'm going to share 3 charts that are perhaps bullish, meaning that leave us optimistic, and 3 charts that are perhaps bearish, that leave us cautious. So most of you will be getting this on Sunday. I believe that's the 31st. Today is the 25th. So I'm going to share my screen and let's get into the charts. So the premise of these videos, again, I'm going to show what's good and bad, but how quickly things change, how quickly narratives change. We're almost halfway through 2023, and at the start of the year, most people were beaten down. Most people couldn't see the light at the end of the tunnel, how things could get better. And now sentiment, market action has changed the narrative, and sentiment follows market action, meaning markets go up, people feel better. When markets go down, people feel worse. A little quirk in human psychology. But it's very interesting to us how quickly that narrative and the sentiment can change based on price. So let's get into the graphs. So there's been a lot of talk about the top heaviness in markets, meaning a handful of companies are explaining much of the index's outperformance. And look no further than big tech here. So what I've done is this is the NASDAQ performance going back from 1972 to 2023. And we're basically tracking when the NASDAQ is trading above, 20% above its 200-day moving average with no occurrences in the past 6 months. So let me unpack that a little bit. So a 200 daily moving average, so DMA stands for daily moving average, gives investors an idea of how a security or an index is performing over an extended period of time. Okay, that's all that it means. So when it's above the 200-day daily moving average, that basically means price has been going up. When it's below, that means price has been going down. A lot of technical traders might use the 50-day or the 200-day to help them make trading decisions, but that's a different conversation. So basically what we're doing is tracking once the NASDAQ goes 20% above its 200-day daily moving average, what is the NASDAQ, in this case, future performance over 1 week, 1 month, 3 months, 6 months, and 1 year. So if you want to just package that up in a neat and tidy box, what happens when the market's been up over the following period? That's all that we're tracking. There's a narrative out there that because tech stocks have been going higher, that future returns could be muted. And the fact is, historical evidence doesn't really jive with that. So let's look at going back to 1975, and I'm going to focus on the 1 year because I feel like the shorter time periods are full of noise. So 1 year after the NASDAQ is 20% above its 200-day moving average, going back over, 50 years, the average return 1 year later is almost 24%, okay? And you compare that with all periods since 1971, where the NASDAQ is basically up 12%, you can see strength often is a precursor to more strength. So the trend is your friend. And you think about the sentiment that I talked about earlier. There's a lot of professional investors, a lot of amateur investors that have missed out on this rally. And when markets are moving higher and you're sitting in a savings account or a money market account, that doesn't feel very good. So there's some fear of missing out going on here. There's some performance chasing going on here. But again, sentiment follows price. When markets go up, people want to get fully invested. When markets go down, people want to shun risk and move over to cash. And you can see the 1 year future returns back that up, where markets go up 20% over their 200-day, and future returns 1 year later are pretty good. Now you might say, okay, Nick, that all sounds well and good. We could get a pullback. That's a fair point. What is the max loss once we have a period of good performance? So we're kind of looking at the extremes here. We have max gain and max loss for each period. And surprisingly, the max loss is also somewhat muted. Sure, there are exceptions. 1978 had a pretty nasty loss of about 17%. 1992, same thing, about 12%. But the rest of these numbers are pretty minimal, meaning once we get good performance, that doesn't necessarily mean we're going to get a nasty pullback. Again, this is empirical evidence. We could get a nasty pullback, but the overall information basically says strength can beget more strength, and that doesn't necessarily mean that we're going to get a nasty sell-off. Okay, optimistic chart number 2. So we've been documented in saying that a potential decrease in inflation is a good thing for equity prices, and that's what's happened. So what we're showing here is the inflation journey, both the CPI, Consumer Price Index, and then PPI, what a producer would pay for their inputs. So if I'm a textile maker, I'm making clothes, what would you pay for the raw materials that go into making clothes? And in general, this blue line is CPI, and this orange line is PPI. PPI has led CPI, meaning this producer price index has led CPI higher, and it's also led CPI lower. So PPI has kind of sniffed out the natural ebbing or decrease in CPI. And you can see we're basically back to where we started this cycle, this high inflation cycle on the PPI index. CPI is still a bit behind, but again, both of these metrics are trending in the right direction. Now, there's a caveat here. You can see we hit peak inflation around June, right? So while inflation has fallen, those higher numbers are going to fall off, meaning the higher numbers fall off, it's going to be harder to go from 3% inflation down to 2% inflation, which is the Fed's target. As those higher numbers fall off, we're going to get a tougher go of it ahead to get down to the Fed's 2% inflation target. And you might say, Nick, I don't know why that matters. Inflation is clearly trending in the right direction. There's a faction of folks out there that think the Fed won't stop hiking until CPI reaches this magic 2% threshold. All right, but all signs point, PPI included, PPI is headed in the right direction. It's only a matter of time, potentially, that CPI reaches that 2% target and the Fed could pause and stop hiking rates. As I alluded to in my last video, it's expected the Fed hikes 1 to 2 more times in 2023 and starts a rate cutting cycle in 2024. But I caution those that want to set their watch to that. The Fed can make changes based on economic data that comes in. The second part of this chart tracks S&P performance following large drops in CPI. So you can see we're down here, as I alluded to. June was the peak thus far, knock on wood. We've seen a 12-month peak of inflation of 9.1%. That's down to about 3%, or a decline of 6.1%. Once we get that decline, you can see going back to 1948, we're tracking S&P performance 3 months, 6 months, and 1 year later. And overwhelmingly, these numbers are positive. You can see in 1 year it's about 15%, 6 months it's about 13%. So falling inflation historically is a good thing for the S&P's future performance. Now, if you look back at headlines over the last 18 months, even social media, what your friends were talking about, it was almost a certainty that we were going to get a economic slowdown, a recession. And I've said this many times, the more people talking about something, the less risky it is, because what derails you, what really bites you in investing is what people aren't talking about. But it looks like, based on market action, based on back-to-back negative quarters of GDP in the first part of 2022, we potentially got a recession. Now, it doesn't need to be called a recession by the government to actually experience a recession, if that makes sense. The government is notoriously slow to call the start of a recession and to call the end of a recession. Oftentimes, they go back in time, it could be a year later even, and say, we technically had a recession in spring of 2022, that spring of 2023. And again, when you look at the market action, when you look at the economic data, when you look at back-to-back quarters of negative GDP, the first quarter of 22, the second quarter of 22, it would not surprise me that we experienced a recession in this period of time that I'm hovering over right now. That's marked in red. And it's kind of hard to see, but you can see this, the GDP growth line here going down in back-to-back quarters. Technically, based on what the academics say, that would be a recession. And again, it wouldn't surprise me if the government calls it right here that we experienced a recession in the first half of 2022. And you might say, well, why is that a good thing? Well, it's a good thing because the recession is probably behind us based on everything that's going on now. Yes, I know the yield curve is inverted. Yes, I know we had a bear market. Yes, I know there's yellow flashing lights. But based on the market action of the U.S. equity markets, it would indicate that we exited the recession sometime either the fourth quarter of last year or the early part of 2023. Remember, equity markets are the best forecasters out there. It doesn't matter what your brother says, doesn't matter what your aunt says, doesn't matter what the media says, the market is always right. Now, let's get into some not so good charts, some charts that cause us pause. Contrary to what you might think about what I've been publishing over the last 6 months, I'm not necessarily an optimist. I don't think markets are going to scream higher and there's not going to be any hiccups. I fully appreciate the risks out there. So what I'm aiming to do now is balance all of this out. So what we're looking at is, right, this goes back to 1990 all the way up to where we're currently at, which is at about 5% on the Fed funds rate. It is expected the Fed is to raise rates by 0.25% tomorrow, which would add another up notch on this chart. But as the chart says, this is the highest Fed funds rate in more than 15 years, which could be a problem because notice the intense straight line and condensed time period of this rate hiking cycle. This is not a normal rate hiking cycle that is prolonged and telegraphed over a long period of time. This was in a relatively short period of time. And when you go from a decade, basically, of zero rates, and you hike them aggressively to the highest levels in more than 15 years, stuff tends to break. And look, we're a highly indebted economy from the government level, federal level, the state level, corporate level, the consumer level. So when you start to think cost of debt going up across the board from real estate to commercial real estate to credit card rates to government borrowing costs, look, they're higher, mortgage rates, stuff can potentially break. And I always say, and I said it earlier, the stuff that you don't see coming is what gets you in investing. A perfect example would be the banking crisis in the first quarter of 2023. I went back and read every Wall Street note talking about 2023 that was published at the end of last year. No one had a banking crisis on their radar. That was a function of rates and bond yields going higher than most people expected. That broke the risk management departments of many medium-sized regional banks. That's the kind of stuff that could happen. I believe there's probably more of this out there. There's boogeymen lying in the weeds that you take a marginal business, let's say, that's barely profitable. You increase their cost of capital by 300%. Stuff is going to break. So there's going to be more stress on the consumer. There's going to be more stress on government and state budgets. There's going to be more stress on corporate balance sheets, which could flow through to profits. So this is something that we're very closely watching. The good news is this is not static. If the Fed senses inflation is under control and things are breaking, it's not out of the realm of possibilities that they start to ease this up and cut rates. That's what the market is expecting in 2024. But again, this is all data dependent. Chart number 2 that causes us concern. The U.S. economy is consumer dependent, meaning so goes the consumer, so goes the economy. 70% of our GDP is predicated on you and I and everybody that we know going out and buying stuff. I've said that before. It would be naive not to look at the consumer's balance sheet. And while these levels are not alarming yet, so this is Discover, who a big chunk of their business is credit cards. You've probably heard of Discover credit cards. Every earnings season, Discover and many other credit card companies like it, like American Express, like MasterCard, publish credit card charge-offs, how late people are, how maxed out they are on their credit cards, how easy it is. And again, the absolute levels are not alarming yet, but the trend causes us pause. You can see here, this is, again, Discover Financial Services, their latest earnings, where 30 days delinquent on credit cards, which is dark blue, and other debt, excluding credit cards. So this could be like a line of credit, unsecured line of credit, a personal loan. And this trend, again, is not favorable. But still, this absolute level is not flashing red yet. This trend is simply flashing yellow. So I was going through JP Morgan's earnings, and their credit card charge-off rate expectation was 3.5%. Their actual charge-off rate was 2.5%, but the trend was the same, that it was increasing. So again, the absolute levels aren't alarming, but if this continues over the next couple quarters, you might see some stress on the U.S. consumer. U.S. consumer will be buying less stuff, which could potentially flow through to corporate earnings, which would impact stock prices. So this is something that we're keeping an eye on. Chart number 3. You all know I'm a big fan of sentiment. Sentiment was in the absolute toilet in 2022 and 2023. And I'll repeat it again. Well, I'll take that back. The early part of 2023. It's starting to change. So what this is bullish investor sentiment over the last 2 years. When this line is going down or when it's low, look at 2022, it's basically clunking around at low levels here. That means people are not optimistic about stock prices. When this line is going up, that means people are more optimistic about stock prices, okay? When this line is going down and people feel like crap, future returns, future stock prices tend to be good. When this line is going up and it's really high and everyone's bullish about stock prices, they think things are going to get better forever, future stock prices, future stock market performance, I should say, tends to do less well or even poor. So I pay very close attention to sentiment. And this was probably one of the biggest reasons that I've been optimistic despite the negative sentiment, negative pessimism, the wall of worry that's been out there the last 18 months. People felt bad. Everyone thought things were going to get worse. It turns out they were wrong. Stock prices went up. Now I'm starting to pause a little bit because, again, sentiment follows price. As price goes up, people get more optimistic. Think about what's happened the last 12 months. Money market fund levels have hit record assets under management, meaning a lot of people are parking money in money market funds given the fact that everyone thought things would get worse. That money has missed out on this rally. That money is not feeling so good about their decision right now, okay? So as price keeps going up, that money is going to want to join the party. And when everyone's crowding into a trade or everyone thinks things are going to get better, something else usually happens. So again, this isn't a reason to get bearish or think things are going to get worse, but if this goes up a bunch, future stock returns tend to be lower, and even stocks can do poorly in that type of environment. So while this was one of the key reasons or the main reason that I've been more optimistic than most over the past 12 months, it's becoming less so, and it might even be a cause for alarm now. So I hope you enjoyed this different format. It's been a great year so far, just like everyone expected. I'm being tongue-in-cheek there. We're going to continue to follow our rules and take cues from the market. We're not interested in narratives or what people say or what Wall Street says. I think the last 18 months have been a case study in why you shouldn't listen to market experts. One thing I've noticed in the news lately, there have been a lot of Wall Street bears, a lot of Wall Street companies that are revising their S&P estimates higher, that are basically admitting that they've been wildly wrong over the past couple of years. So I really would encourage you to create those information filters. Don't listen to opinions. Don't listen to hot takes. Don't listen to narratives, but pay close attention to what the market is telling you, because the market is always right. If you have any questions about what I covered today, how Pure Portfolios works with clients, our investment process, feel free to shoot us a note at insight@pureportfolios.com. Thanks for watching. See you next time.